Passive activity loss rules are basically a "you can't use that loss yet" system. In general, passive losses are deductible only up to passive income. If your passive losses are bigger than your passive income, the excess is disallowed for now. On the EA exam, they love the simple math. Passive income caps the current year passive loss deduction. When a passive loss is disallowed, it doesn't disappear. It becomes a suspended passive loss carry forward. Next year, you bring it forward and run the same limitation again. Non-corporate taxpayers use Form 8582 to total passive income and losses. Figure what's allowed this year and track what gets suspended. Think of Form 8582 as the traffic cop for passive losses. Quick example. If you have $7,500 of passive income from one activity and a $10,000 passive loss from another, you can deduct $7,500 this year. The extra $2,500 is suspended and carries forward. The key exam move is to net passive items together first, then apply the limitation, and only then decide what gets carried forward. There's a big escape hatch, a complete disposition of the passive activity. If you sell your entire interest to an unrelated party in a fully taxable transaction, any suspended losses from that activity are released in full in that year. EA exam tip: watch the words entire interest, unrelated, and fully taxable. Miss one, and the losses may stay suspended. Now the weird one: former passive activities. An activity can be passive in earlier years, but not passive now because you materially participate this year. In that case, prior suspended losses from when it was passive can be used, but generally only up to the current year income from that same activity, so the carry forward can soak up profits once you become active. Last exam trap: don't confuse PAL rules with other limits. The $3,000 capital loss limit is a totally different rule and doesn't cap passive losses. Also, you don't need capital gains to use released passive losses on a complete disposition. The PAL system is its own bucket: passive income, passive losses, suspended carry forwards, and the disposition release rule. Marissa is an 8% limited partner in Riverton Vineyards, a partnership. She doesn't participate, so she's just an investor. During the year, she sells her entire partnership interest to an unrelated party and stops being a partner. She has $18,000 of suspended passive losses from prior years. What's the tax treatment of those suspended losses on her individual return? Think about it. The correct answer is, she may deduct the suspended losses in the year of disposition. A complete disposition of her entire interest to an unrelated party in a fully taxable sale releases the suspended passive losses in full. A tempting wrong answer is the one saying she must wait for other passive income, but that's the general rule. Disposition is the exception. A closely held corporation can qualify as a real estate professional if more than what percentage of its gross receipts for the year came from real property trades or businesses in which it materially participated. The options include 50%, 90%, 40%, and 80%. Think about it. The correct answer is 50%. The rule is more than 50% of the corporation's gross receipts must come from real property trades or businesses where it materially participated. 90% sounds believable because it feels like a stricter test, but the threshold the exam wants is just over 50%.